Welcome to RealVision. I'm Ed Harrison, and I'm going to talk to Bill Campbell, who is a portfolio manager for global bond strategies at DoubleLine. Bill, welcome to RealVision, or welcome back.
Ed, thanks for having me back. It's a pleasure to be here.
I was telling you before how we're going to do this is I want to start people off knowing that you and I actually talked, and we had an interview that appeared on the platform at the end of May. It was basically a master class in non-U.S. Markets, which is where you are a portfolio manager. And we went, soup to nuts in terms of currency strategy and bond strategy outside of the United States. And I think people really appreciated that interview. But you're someone who's sort of a big thinker. You're thinking about not just what's happening for the strategies right now, but what sort of paradigm shifts are down the road. And one of the big ones that comes up to mind, and we're really very interested in that at RealVision, is digital currencies. So talk to me about, first of all, what is a digital currency from your perspective, from where you sit, and how are you thinking about that?
Ed, thanks again for having me back. I think that this is actually a historic time for global financial markets. I think that the ideas that are being brought forward by central banks right now, and the BIS has been putting working groups of central banks together on how the central banks are going to implement the new central bank digital currencies, is going to be a historic sea change. It's going to be a revamping of the global financial system. And I think as international, me as an international portfolio manager, and all of us as international investors, it's our job to try to understand as best we can the changes and the potential implications that are coming down the pipeline. Now, these central bank digital currencies have not been implemented yet, but what we want to do is identify and hopefully be able to see in real time some of the themes that we're going to discuss throughout this hour. And then if we do start to see the signs that these themes are happening, it can help us position ahead of them. And that's kind of the basis, I think, for a lot of the thinking we're doing around digital currencies right now. So I think to understand why I just made the statement that I think it's really a historic sea change it's first to understand what is a digital currency? And I think the easiest way to understand it is it's a currency in digital format. It's a medium of exchange. And this medium of exchange can be met by both private and public money. And the medium of exchange happens, on the digital side. It can happen through a currency such as Bitcoin. It can happen through a settlement system such as Libra. But it can also happen through, transactions on things like credit cards that we, are all familiar with. And when we broaden the scope to include all digital payments, which central bank digital currencies are not just, that this topic doesn't just focus on the currency itself, which is certainly a key part, but it also focuses on the global payment system. When you include all of that, right now, about 95% of all transactions are being done digitally, and a lot of them are being done via digital platforms. So in a lot of ways, this is the government's behind it's kind of behind the starting block. And
right.
The sector has already led the way on this for years. When we start to think about how far ahead the private sector is on, just the proliferation of let's call it end-to-end consumer digital settlement use. I think this is not only a research fascination that banks should be interested in, but this is a pressing policy need, and it's going to push a lot of new policy and a lot of new frameworks and a lot of new market structures into the global financial system. And I think one of the items that is starting to push central banks into this arena is the creation of digital money by these private actors,
right.
whether it's MasterCard or PayPal, is actually a liability of that particular company and is not a liability of the government. So now you start to, creep into financial stability issues, which absolutely is going to pull the financial authorities into, this discussion. So this kind of opens up a little bit more of I know this will be a little bit more of the theoretical side of what is money. And really, money should be a public good. It is a public good, and it should be a liability of the central bank. It should be a medium of exchange that is legal tender for each economy. And right now, for example, Amex is not accepted everywhere, but the dollar is. So when central banks first introduced the digital currency, basically it's just going to be a replacement of the currency as we know it, the paper, cash bills that we receive from the Federal Reserve and use as currency. It's just going to be that in digital format in its simplest form. But it's a little bit more profound because it now will be a liability of the central bank. It will be legal tender, for each economy, not only the U.S., but each economy is going to, implement their own digital currency. It has it has then the property of a store of value. I know there's a lot of discussion on the store of value and whether, some of the new private coins can meet that standard. And I would argue that, the private coins are still too volatile and they're still a little bit too much in their infancy to truly meet that standard. Although I'm sure that there are some very sophisticated people who might want to take the other side of that argument. I just propose that given where we are today with all of the private coins that are issued, that volatility makes the store of value question a little bit more open, and also it needs to be a common unit of account. And it's not clear that we have a standard on the private side that is the common unit of account. We still always go back to what is the central bank's currency, what is the central bank's what is their back liability is our common unit of account across each nation.
The one question I think that sticks out for me is when you were talking about even before you started talking about the currency of account. I was thinking about, you said that it should be or has to be a liability of the state. Why is it that we can't have some sort of free-for-all where different currencies are competing against each other, issued by different private actors, all competing against state money at the same time? How is that not a good outcome for going forward?
Well, you can, and we are right now. But ultimately, you're introducing the credit risk of an individual company, can either be worse or better than that of a state. And I think, you bring up a very profound point. When we think about, I think the idea of Libra, like this end-to-end payment infrastructure, is kind of interesting because, it's backed by a company, a very strong company like Facebook. And when we, think about, major countries, I think the liability of those governments, or of those central banks, are very strong and probably stand up stronger. But when we start to move into emerging market countries, and I know we're going to get into a lot of, these issues about, institutional strength and, trust in the government. All of a sudden, when we do the credit analysis, you might get into a situation where you do have a private end-to-end system like Libra, being preferable to a state currency. So I think that what the situation you described is the situation we're in today. I'm not making the argument that one particular path, the central bank digital currency, is the path that stands above all. I'm merely pointing out that in the global system right now, that we're going to see a complete revamping of the way people, I think, do credit analysis and look at countries versus private alternatives. So there are a lot of twists and turns to come. And this is obviously one area to keep an eye on, especially when it comes to markets outside the United States.
Yeah, and let me ask you a second question, because I was actually looking at some of the notes that you had taken before, and one of the things that stands out for me is that you say that 95% of money is already digital. And I was thinking about this in regard to Libra and state money. Why, I get the impression that central banks see Libra as a threat in some capacity. Suddenly, we hear about the central banks definitely now saying, okay, now is the time to get into digital currency. Whereas we're already at the point where that 95% of all money is digital. What was the impetus? What was the thing that really, got the light bulb on for them that we need to get on top of this?
Well, I think there are a couple of items that have potentially turned focused their attention into the digital arena. One is obviously that the majority of private transactions are settled digitally. The other item is when we think about where central banks are today, we've kind of we've reached a limit, really, as far as exhausting the traditional policy toolkit of using interest rates to try to set monetary policy, the unorthodox monetary policy toolkits of buying both government bonds, private bonds, in some cases equities. And we're in the middle of a historic crisis of COVID, where right now we're starting to see the second wave of lockdowns come through Europe, and I think you guys have done a good job of covering that issue. There's also the concern that structural unemployment might be much higher going forward, given the proliferation and pull forward of a lot of technologies and the disrupting of supply chains that are happening due to the coronavirus. So we're at a historic point on the policy side, whereby central banks' toolkits have been exhausted, and this would actually potentially provide a new tool for them, in order to affect, what we've seen right now is central banks and have been asking fiscal policymakers to do more. And we just finished the IMF's, biannual meetings, and I think what we saw is an interesting message change from the IMF, whereby they're telling countries, if you have room, now is the time to use it. And there's a discussion about using these extraordinary monetary policies of bond purchases and yield curve controls to effectively subsidize fiscal policy. And then we get into all sorts of issues around, how is fiscal policy going to be implemented? And that's where the digital currency, I think, offers that new potential policy toolkit of being able to go that final mile, allowing central banks to not only provide, currency and liquidity to the banking system, which it currently does, but it will now be able, through a central bank digital currency, to provide that to the individual. And let me just slow down for a second here. With the quantitative easing that's happening, basically what you see is central banks are purchasing assets from the private banking system, but then they credit their reserve account. And it's up to the banks to decide how they're going to allocate those reserves to the real economy. Are they going to buy a financial asset and market make? Are they going to give a loan? And unfortunately, what we've seen is that credit creation really isn't happening. And we've seen the velocity of money fall across pretty much all economies. We've seen inflation not take hold, which has other structural reasons, but one of which would be this hurdle of getting all this excess liquidity that's sitting in the banking system out to the end public, who when we look at the end public, especially the lower income parts of a society, are likely to spend more out of necessity. They save less and They spend the cash that comes in. So that it's that final policy tool that I think is, it's a creation of a new policy tool, a potential for a new policy tool in the middle of this crisis, whereby a double dip recession, at least in internationally, is something that we just can't completely discount and say that's not going to happen. And I think that beyond just the need for central banks as the financial authorities to kind of get ahead of all the private infrastructure that's put in place for digital payments and this digital financial infrastructure, you also have the policy needs that are also creeping in to really create the motivation for this point in history to be why your central banks are going to be forced into implementing this. And I know we're going to get into a lot of the implications of what some of the choices might mean for economies, but I really believe that this is coming right down the pipe. And as we've seen, the European Central Bank and the Bank of Japan are already in comment period. I know they're trying to say, well, we're trying to take our time. Jay Powell is saying, we're taking our time, but we're watching. And he sat on a panel with the BIS, which tells you that this is an area of focus and a highlighted area, for all the world's major central banks.
I really appreciate the neutral tone that you give that in terms of putting it out there. But I want to inject a certain skepticism into all of this. Let me read something to you. Actually, Here's the quote that I want. It goes like this: "Quote: The acute phase of the credit crisis ended years ago, giving way to nearly a decade of global economic growth. The central banks, however, have lacked the courage to unwind QE." That quote is from a gentleman by the name of Bill Campbell. It is from the year 2018 in a DoubleLine piece called "Quantitative Easing: Welcome to the Hotel California." And I think the implication there is once you have the tools, you kind of want to use them and not unwind those tools. We're in a completely new paradigm potentially when you talk in that way. We've gone from reducing interest rates to asset purchases with quantitative easing, and now you're saying that we are potentially going to the new paradigm of digital currency.
That's right. So, well, thank you for pointing that quote out. I think it was obvious to see that the fact that central banks gained those new policy tools, and they always said that they understand the economy better than all of the rest of us, and they'll be able to unwind extraordinary policy. Always seemed like a fantasy to me, because when we did see opportunities for them to take that off ramp even marginally, they never did. And I think that that's basically where we're going with this policy. With the potential is that with the implementation of central bank digital currencies, we can get into this quasi fiscal aspect, and I think it's very hard to roll back. What the old saying of there's nothing more permanent than a temporary government policy. I believe Milton Friedman said it best. And it's absolutely right in that sense. So it's coming. Now let's think about what are the potential implications of the digital currency, central bank digital currency rollout. The first thing is there's going to be a lot of tensions, as with any government step forward or reach into the private sector. There's always tensions that arise. And the first one is with, and the most obvious one is with the banking sector. So, the central bank digital currency right now, effectively, many people may not think about this, but the central banks actually do have a form of central bank digital currency that's already out there, in bank reserves. So bank reserves are custodied at the Fed. They're, the problem is they're kind of like a wholesale currency. They're stuck in the banking sector. But when you think about what is a banking reserve, it's a preferred asset. Like it's, deemed as one of the safest assets, in the banking sector that you can have. And, a lot of banks want to have it, for safety reasons, to keep themselves well capitalized. Well, let's take that now one step one step further with the introduction of a digital currency to the to private depositors. You could end up in a situation where financial stability could become at risk, as there could be a preference for people to say, hey, I would actually prefer to have all my assets custodied at the Federal Reserve. So one of the questions right now is, will central banks allow individuals to have custody accounts, demand deposit accounts at the central bank? And Loretta Mester actually said, look, there is some legislation that's looking at that, as a worst case scenario, that we may have a situation whereby we need to provide payments to individuals, and potentially we could pass legislation that would then mandate that all people have an account at the Fed. But I think then you get into this issue that you could have a preference for assets being custodied at the Fed versus at Deutsche Bank or Bank of America or J.P. Morgan, which then starts to create issues for those banks, as they would lose their deposit base. Then you say, well, you could have you could walk yourself down the line where you say then nationalizing banks in that situation would make sense, because now the government's going to provide the credibility that those institutions will custody those assets safely.
When you mentioned Loretta Mester, I think she's supposed to be considered a hawk. She's the president of the Cleveland Federal Reserve. The thing that you introduced just makes me think. One of the things in 2008 that we were talking about was the fact that a lot of these investment banks were relying on wholesale deposits. Goldman Sachs and the likes, they've gone out and they've actually tried to attract deposits. But you're suggesting that actually, if we take a supposed hawk at the Federal Reserve's position, in a worst case scenario, the Fed would be competing with those banks for deposits.
Correct. Yes. And that then puts into question the entire system of fractional reserve banking. So this hasn't been implemented yet, but this is a risk that if we see all of a sudden the architecture come out that central banks are saying we're setting up citizens custody accounts, I think we need to take a hard look at the banking sector. So I point that out, as we discussed at the beginning. What are some of those signposts and implications? Let's that's something to just tuck away. And if we start seeing that, that's a potential signpost and implication that maybe we could then take advantage of in markets. We also need to think about credit disintermediation. Mm-hmm. So there are a couple of things that come to mind. The use of Visa and MasterCard, and all of just the traditional electronic payment systems that we use. We all use it. You and I, all the way down, like across the borrower spectrum, from strong borrowers to weak borrowers. We all use credit cards, and some of us pay it off quicker than others. But you could see a situation whereby if you have very strong borrowers that, say, I really don't want the fees associated with, Visa and MasterCard. I think my preference would be, to pay everything more on a debit card basis. You could have a situation whereby, the interest rates that are already high, for carrying balances on Visa and MasterCard go way up, because that final element of subsidy of the stronger borrowers in the system disappears. There's some good aspects, of credit creation, that are happening as well. I have seen the idea that, using private, the private sector technology of, security tokens can help sectors that have not received credit, such as small businesses, potentially, start to receive, more credit, more funding. And I think actually you have another video that goes deep into detail, on that. So that's a potential positive side. And I think one of the issues I pointed to of the current central bank policy is What have we seen since March is we've seen the majority of central bank liquidity go to either wealthy individuals through asset price appreciation or go to large companies as debt has been issued by corporations, and it's really left out, the small business, in the small business sector. So that's kind of an interesting innovation that could actually boost potential growth in countries that are able to effectively do that correctly. But part and parcel to just that little element would be, how governments set up the domestic payment system. Governments are going to get more involved. And, I think what's ultimately going to happen is they're going to increase operational efficiency, both internally and externally. And, you're going to see, a lot of these larger transactions that, banks now facilitate, become much more commoditized and much easier, to do in, either new government payment systems and new, private structures. And that's going to disintermediate, a revenue source from banks as well, who, especially for, large cross-border M&A activity, for the final, payment settlements. I think that, there's a big potential for the new architecture that's coming in with these central bank digital currencies and their companion payment systems to displace banks in that, in that area of credit creation as well.
I think this is a good time, a good example to talk about some of the implications for the investor before we go on to more, because as you say that, immediately I think to myself about how do you implement this in Argentina? What are the implications in Argentina in terms of legal tender, public good, common unit of account, and the competition of this digital currency with private digital currencies? And then what happens? How do you, as a global portfolio manager, think about this new world that we're living in, the country risk associated with Argentina? Could you maybe use that as an example?
Well, it's a very so that's a very deep, a very deep question that you just asked. I think, initially, you're going to end up in a situation, whereby Argentina, I think, would be a difficult example because you already have a lot of exchange rate controls that are put on the country. And the ability for money to leak out and new platforms to get in is very controlled, as is with China. And I think ultimately we're going to end up in a situation where you're going to look at countries and start to say, okay, institutional strength becomes a major factor of how we're evaluating the country. And what I mean by institutional strength is, the government's ability or lack or willingness not to monetize deficits, the government's protection of privacy rights, and also the government's willingness and ability to keep an open capital account to allow money to both come in, but also to leave and maybe go to either another public platform or a private platform. So countries with lower institutional credibility obviously, are going to face a balance of payments risk similar to, what we're seeing right now. And the digital currency, could work in, one of two ways. My concern is that it gives a much stronger access to the government in all payments and all financial transactions, which then gives them more control and the ability to, prevent capital and savings from leaving that country. So, in one respect, I think you could see a situation whereby, if used incorrectly, or if used for, purely domestic political gains, there's the risk that it could increase the inequality issue because because capital that's already trapped in a weak system would then get, even more so. And though you would get into a very much a haves and have-nots. So people with the wherewithal, either you already have existing savings outside of the country, or you have through political favor could get savings out. You would be in a preferable situation, compared to to that domestic capital. But I think more to the point, like getting back to kind of the institutional strength and how we're thinking about countries going forward. I think that these new payment systems that central banks are looking at are going to there's a big question about negative interest rates, and can the policy can governments try to affect outcomes by saying basically we're going to tax your cash. Basically, the value of your cash is going to start disappearing through time if you don't use it. So this is, this is, and I know there's been a lot of research into, why it would be a great thing. You'd increase, the velocity of money and all the rest. But I think this is a very dangerous idea. And it's going to, first of all, it's a tax. Like,
Right.
let's just start out with that. Secondly, it creates the real need for a new safe asset and a safe digital asset. So if you think about that your demand deposit now, it now can just start dwindling over time. Any savings you have, you're going to have to invest in something, right? You're going to have to get it out of the cash, like out of this digital cash system as quickly as possible. So obviously you have bank risk there that, demand deposit accounts, might be moved. Now this might be where banks could get creative and offer like their private, cash demand deposit account, and then create a preferential treatment to try to regain, some assets. But barring that, if we're in a situation whereby people are governments are charging negative interest rates on cash, I think we're probably in a situation whereby government bonds, are no longer, yielding a positive rate, likely, or at least they're at their lower bound and unlikely to provide you protection in a risk-off scenario. So
that's a big point. And why is that they wouldn't provide protection in a risk-off scenario?
Well, once the effective lower bound is hit, it cannot rally any. The idea that the government developed market government bonds and treasuries are kind of the last safe asset on the world is due to the fact that you think that there still is room for capital appreciation, or enough money is going to go into the government bond market to cause rates to rally and make that security appreciate in a time of risk off. And I think this is actually a very important point. We're discussing, one of the discussions that, is kind of permeating the market right now is the 60-40 portfolio. And, government bonds have historically been viewed as that risk hedge in that 60-40 portfolio. Well, I just discussed the need for a new safe asset. And I've heard a lot of discussion. Well, right now what I'm hearing is gold and Bitcoin are two natural candidates, maybe to, replace treasuries in that 60-40 portfolio. And what I would say to you there is, my opinion is that gold and Bitcoin are debasement assets. And I say that because when I look at scenarios where volatility spikes, and this is, let's put Bitcoin out for a second and just stick with gold. In 2008, when we had the true volatility spike, you had the deflationary scares whereby break-evens rallied much more than nominals and caused real yields to push up. What happened there? Gold sold off. In March, we saw a similar with flash in the pan of that exact same scenario. Vol spiked, and what happened? Gold was actually sold. So in a 60-40 portfolio, that safety asset is supposed to offset the fall in the risk-on asset in those spikes of volatility. But what actually ends up happening in the case of gold is gold doesn't rally until you get the commensurate or the follow-on of the central bank or fiscal authorities then implementing a massive stimulus measure. So in effect, it's not trading the vol trade, it's trading the debasement trade. And when I look at the Bitcoin correlations with risk assets during, risk-off environments to 2018, March of 2020, I see a very high correlation to the way gold behaves in those. That it's appears to me that it's trading more the debasement risk rather than like the volatility, deflation, risk that you're trying to get. So right now, with government bond yields hitting their effective lower bounds across developed markets, and with the risk that you could implement, a negative rate policy on cash when central bank digital currencies are implemented, creates that need for a new safe asset. And I don't know what it'll be, but it's got to
Right.
be, a digital safe asset that, is usable by most people.
Let me riff on that in a bunch of different ways, if possible. I don't know if you know, I spoke to Ben Anker, who's at GMO. He's
Oh,
a
yeah.
he's their asset allocator. People would call him the heir apparent to Jeremy Grantham, and he was writing up about the fact that actually you can see from that March event that the negative yielding countries, there was no offset in their 60/40 portfolio as the market melted down. So you had the huge vol spike, equities were plummeting, and actually those negative yielding assets did nothing. And sometimes they actually added to your pain. Whereas only in the countries that had positive yields, and those positive yields were very minuscule and have reduced since then, did you see any sort of offset. So we're at a point now where we don't have any offset across the developed economies, and that means that the full force of the vol spike that is caused by declining asset prices on risk assets is going to be felt in an individual's portfolio if they're 60/40. The thing that I find interesting is this also this negative interest rate part that you were talking about. I immediately thought to myself about the tax on, because you were talking about the digital currency negative interest rate. That's actually a tax. We're seeing that tax right now. In real time, we're seeing in Europe that they're trying to implement at a very modest amount negative interest rates. And it does not seem to be creating that increased velocity of money that you would want to see. So when people are talking about policy implications of this tax, how do you think about negative interest rates in terms of its ability to actually, do what people want it to do?
I think that negative interest rates do not stimulate growth and inflation. And I think that I'll pause for dramatic effect, but I think that is at the heart of it. You're coming to you get to a situation where people, all of a sudden I've heard, some very smart people start to, say negative interest rates on, what were safe assets. I just want to find the least negative interest rate because it still, helps store value in a situation whereby, growth remains uncertain, and I don't necessarily want to put all my money, to risk in the credit markets or the equity markets. So it's almost like an insurance, premium that you're paying. And it's a shame, but that's where the world is. Governments have been able to get away now with charging effectively implementing a new tax on their population. And they're implementing policies that just aren't working, that aren't proving to generate the reflationary, strong growth and inflation impulses and wage increases that all of these policies, are targeted at. I think when we, think about the construct that you just laid out, there still probably is, one more, one more act left in, some developed markets, government bonds, in the face of another, a second, a double dip, or a second, recession, because there are some, you can find, some slightly positive rates, across the globe. And what we've also seen is, the back end of the curves, generally, don't really go too negative. They don't really try to test negative until the central bank breaks that floor, and
Right.
then you tend to see a rally in government bonds into negative rate territory, which is kind of that one final one last act, as I say. And I'm thinking like the
Eh,
UK,
Okay.
Australia
By the way,
would have those areas.
if you talked about specific policy, just from an investment perspective, I'm thinking immediately UK when you say that, because that's an asset, the gilt that it's been toying with the negative. However, the UK central bank hasn't said that we're definitely going to go negative. We're just thinking about it.
Right.
But you're saying that when they actually do go negative, that then you have another uh, potential for price appreciation from actual negative on the duration
Correct.
aspect of that safe asset.
Correct. Yeah, no, that's exactly what I'm saying. And I'm using the German Bund as a playbook with the ECB, for that basically once the negative policy rate is implemented, once that Rubicon has been crossed, you have the long end of the curve has one potential, last gasp of, capital appreciation or rally left in it. But we're effectively, if that's it, then that truly is, in my opinion, it as far as traditional, non-traditional monetary policy, forcing central banks to revamp the tool and cross into this quasi fiscal policy space, which they've already done. But I do think that monetary inflation can absolutely come back. Inflation caused just by the increase in money supply, by central banks first implementing digital currency's ability to put government cash in people's bank accounts. But then we got to ask ourselves, this is the deficit spending versus debasement discussion, and the question is, what type of authority then is given to central banks when this new plumbing has been put in place? And I think it really matters that if the new policy being put in place is funded by government spending, tax increases, and there's the fiscal offset to it, uh, then it's kind of a new fiscal policy tool. I think the real concern and the real risk is that we'll see a situation whereby debasement happens, and central banks will merely print the money to go directly into individuals' bank accounts without the offset on the sovereign government side from the fiscal authority of the sovereign government. This is a big distinction, subtle but big, because then that's outright monetization. So
Right.
we've seen a little bit of like testing of monetization on central banks and and governments. The UK has the Ways and Means facility, but that's a direct payment. It's kind of like an overdraft account that the UK government can use, but where they take money from the central bank to fund a current emergency program, but then they promise to pay it back quickly. You're seeing Indonesia do, direct, you're seeing they're getting around it by saying, well, we're issuing a note to the central bank that the central bank could then, sell to the market. We promise that, it's a priority claim that we'll pay it back as well. But we're seeing like these tests of the boundary, for, is this deficit spending or is this true debasement?
Right.
And I think that is such a slippery slope, and that hard line that's been in between the fiscal versus the central bank, the fiscal versus monetary authorities. It's been eroded over time through, the quasi-fiscal, help from quantitative easing, yield curve control, and all of these policies. We're starting to see little tests, here and there, and it's again emergency use only. This is just an emergency case. Don't worry about it. Look somewhere else. This is something to keep an eye on, because this would, in my opinion, open the floodgates to monetary inflation. Where you really start to see inflation is, it starts increasing because of, true money printing and debasement. And this is where I think Bitcoin and gold can absolutely protect you, in those, in these scenarios. So I think I just wanted to separate out, that my thinking on that. I just wanted to make sure I clarified that, I think investors need to be very clear about the risk that the asset is trading to. So when you're putting your portfolio together, you're not counting on it to do something that maybe it's not quite doing.
Right. And the way that I'm framing in my mind what you're saying is we have two policy options here when we're thinking about quasi or actually outright fiscal policy from the central bank. The one that we first talked about was going more into the negative interest rate, the tax that we're already doing with regard to negative interest rate policy. But you can move from there to a much more sort of debasement type of strategy where you just credit accounts, that the central bank is engaged in the deficit spending, so to speak. And that's a completely different scenario where, you can, the central bank, rather than just giving money to banks who have assets and then hoping those banks will move those assets to the right places, they're saying, actually, we're going to target specific places. We're going to credit specific accounts and directly impact the private sector that way. Right.
And that is such an important, this whole discussion, I think, has been important. And again, all of this is so new that there's so many different avenues that we can dive into, in the rollout of central bank digital currencies. But what you just discussed, the ability to target outcomes, that opens up, in my mind, it kind of wraps us back around to, the institutional strength, but a privacy discussion. And in order for central banks to target outcomes, they need visibility into where exactly the currency is going and the payment infrastructure. And, I think the privacy concern comes as to, what type of visibility do we as citizens want to give to the government as far as, all of our digital payments? So let me just give a quick example to kind of highlight what's going on there. The central bank could print a digital currency and then could allow a private bank to use some of its reserve assets, buy the digital currency, and then that private bank can distribute the digital currency the way it sees fit. And all of those transactions then would reside on a server at the private bank, such as Bank of America. And if there's a concern of taxation, money laundering, or whatever else, that the government would have to first go to court, get a warrant, and then obtain those assets from a private party, being Bank of America in this example. On the flip side, if you really want to be able to target outcomes, what happens if all of that information resides at the central bank on a government server? Now you really, really need to have confidence that the judiciary is going to protect personal privacy rights, because the potential for abuse is very high. Right. But in order for, now, this is the trade-off. I think in order for them to be able to implement the outcomes that you were talking about, they need that type of visibility. So this is this then becomes a situation whereby country by country we can start to say, does this country actually protect individual privacy rights? Do they have that type of strong institutional strength? And getting back to potential market implications, I would believe that countries with stronger privacy rights and an institutional framework would be preferred for capital, in that new environment versus countries that don't.
Interesting. And let me say that a framework that I'm thinking about of this in is what I would call the currency as a release valve. And by that, I mean, when we're talking about debasement, direct monetization, the interest rate isn't necessarily the release valve in the sense that the central bank can engage in yield curve control or any sort of ability within its own domain to suppress interest rates, so-called financial repression. But you do have the currency there, the release valve. And so in some senses, if we get to this new rubric where it's a Hotel California-like scenario that you were talking about, QE became, then you have this competition, this sort of race to the bottom where people are saying, actually we can get some juice out of our currency being depreciated because we're crediting accounts. Let's do that so we get the double benefit of A, direct injection to the places that we want the money to go, and B, the release valve being the currency, and we can therefore steal growth from the global community by having a weaker currency.
Yeah, I would. I would push back a little bit. I see exactly what you're saying with that, as like a potential risk. And first of all, I totally agree that quantitative easing, extraordinary monetary policy is about the currency and is about gaining market share and benefit from currency depreciation. But I go back to the risk that I said that, I believe if you get into true debasement via, monetization, that the risk of, monetary inflation getting out of control is so much greater than the benefit you would get from any currency depreciation in that scenario, that I would, I don't think that, that in my opinion, that's not the policy prescription because of that trade-off. But you did bring up, just on the currency side, I wrote a recent paper. I've been doing some thinking about, the dollar's reserve currency status.
Right. That's where I was going next as well.
Oh, yeah. All right. Do you want me to?
No, go there because I'll tell you that the way I'm thinking about it is the Brits going hat in hand to the IMF in 1976. I'm thinking of that as sort of what happens when you lose reserve currency status, and therefore you either have to jack up your interest rates in order to attract money because of the currency, importing inflation like crazy into your economy, or you go hat in hand to the IMF like the Brits did. I mean, that's what happens when you're not the world's reserve currency.
Right. So I don't think we're going immediately into an insolvency crisis in the U.S. And I think that's, we can just say that because, there's really no outstanding government liability in another currency. That being said, the implementation of central bank digital currencies and the architecture that the central banks are talking about for the payment systems are first domestically focused, but then these working groups are international collaborations of central banks. So what I envision is in not the first iteration, but as we start walking through time, we're going to see a system whereby the new electronic payments platform that's going to be implemented across the globe by each country's central bank will all talk to each other. And ultimately, what that's going to do is it's going to allow countries to be able to bypass the US dollar in their trade, in their international transactions. So now what you're going to, I think what we're ultimately shooting towards is a world in which countries can do bilateral, instantaneous government-backed, government, facilitated settlement of bilateral payments between countries on more of a web-like, on a web-like infrastructure. So we're moving from the dollar being at the heart of all of the majority of global transactions. So the dollar, the BIS said that in 2019, the dollar was about 88% of one side of all currency transactions, with the number 2 and 3 being euro at like 32% and yen at 17%. So the dollar, remember, currency, is one currency versus the other. So again, this is the dollar just on one side of those transactions. is about 88%. And the other item is the current global payment system that's used across the globe is SWIFT, where SWIFT connects banks internationally and allows international settlements. And it looks like about 85% of all international settlements through SWIFT are settled, are dollar settled as well. So this gives, the dollar's weight in the global, system is roughly that. It's extremely large. But when you actually look at all of, what is, the bilateral payment structure of each individual country, it's much less. So countries right now, because they know trade needs to be settled and all their international transactions need to be settled in dollars, they're hoarding dollars in, their FX, reserves at the central bank, for example. And, the dollar is the dominant allocation in FX reserves. What I've just described to you is a situation where central banks now will see, the payments actually match the true balance of payments transactions. Instead of payments, the transactions being a lot more diverse, but the settlement being in dollars, now it's all going to be a much more diverse mix. So that's going to, start to remove the need, for banks to accumulate, dollars. Now, the U.S. dollar, when we look at the U.S., we run a current account deficit, and right now we, also have the privilege that a lot of central banks and other individuals kind of recycle their savings back into U.S. assets, so they have kind of that global reserve asset. When that disappears, I think that you all of a sudden get the structural pressure, both from the rebalancing of the reserves from central banks, but also from the yearly flow of the negative U.S. current account. Starts putting structural pressure on the to the downside on the dollar. And when we think about we have to think not just about the the flow effect, but also the stock effect. And the U.S. runs a very large negative net international investment position, and that's just a long-winded technical way of saying the majority of global savings is, a large portion of global savings sits in the U.S. dollar. So not just on the official side, but on the private side as well. And when you start to see the dollar come off, I could see a lot of that savings, come back home and come back out. Now, this is not a tomorrow trade. We're going, obviously, we're going into potentially a new era in, lockdowns because of coronavirus in Europe. There are a lot of questions, that are, coming near term about this recovery. So, the dollar, I think, in its current status, still will serve as a safe haven asset near term. This is a medium term structural item that we need to pay attention to that has the potential to have huge ramifications, for dollar downside. On the flip side, too, is, when countries are allowed to settle, currencies, bilateral transactions just between each other, that gives them the, additional privilege that the U.S. only had and never, doesn't really use. But you can print money to settle the payment if you're just a little bit short.
Right.
So this then starts to, open the door to, getting back to these debasement risks that you were talking about. And I think then, if we kind of circle the loop back to the debasement assets, it's not only private people like, private investors who, are wanting to think about diversifying, into debasement assets that, protect you against debasement like gold. It's also going to be central banks. So I think that, that's another item that, central banks may be, looking at. And we've basically, putting more of their reserves into gold. And interestingly, the two countries who have already implemented global payment systems that are in competition with SWIFT are Russia and China. And what are Russia and China doing? They're increasing their allocation to the reserves in gold. So I think that it's, that's kind of a trend I think that is likely to continue and be accelerated, by what's likely to come in a new global payments infrastructure.
Right. Now, let me go back to the UK and the IMF and why I think that's interesting. First of all, I think that there's a chicken and egg scenario with regard to the current account deficit. That is that from a capital account perspective, the bid for dollars, is that driving the current account, or is the current account deficit driving the capital account with regards to the U.S.? We do know that there are other Anglo-Saxon countries. Australia is an example. If you look at their current account, the UK, massive gaping hole in their current account relative to, say, 1980 or 1970 in both of those cases. When you look at the U.S. dollar on a purchasing power parity basis, were it to go down, it's against the Australian dollar, it's doing relatively well purchasing power wise. It's doing relatively well against the pound, partially because of those current accounts. It's countries like the euro against Switzerland, where you see the biggest problems on a purchasing power parity basis, where I could see the dollar going down. Now, let's just say that the dollar does go down as a result of the move to bilateral settlements of accounts. At that point, suddenly the U.S. People who have this massive current account deficit are importing goods that are in currencies that are appreciated against the U.S. dollar, and therefore we're importing a massive amount of inflation into the U.S. system. This is what happened to the Brits in the 70s. And at some point, they were forced to say, wait a minute, okay, either we jack up interest rates in order to get our currency up and stop this inflation from being imported, or we have to figure out some other way to get out of this problem because it's killing our economy. And in their case, they decided that they would go to the IMF to help relieve them of the problem, and that's what precipitated their crisis. But they did have the degree of freedom; they could have allowed it to continue to roll, but unfortunately, they just felt wedged in by the implication of massive amounts of unemployment that would result from the crackdown on interest rates.
So all points well taken, and I just point out sequencing to you that ultimately we may get into the scenario that you're talking about, but near term, I think that not near term, but in the initial phases of this, given the large stock of foreign savings in the U.S., the capital account outflows are going to overwhelm on the currency. On the currency side, full stop. And, I think that importing inflation at a time, too, when potentially policy is starting to stimulate inflation, causing the need to, rethink what is the interest rate policy, is going to be, that is going to be a big discussion because in the scenario that we just laid out, growth is also going to be challenged. So you could be in the middle of, a true deflationary shock when, I guess you would be, what you're arguing is now you're going to need to support the currency. You're going to have to, let rates back up aggressively. And that's going to take a sea change, in policy. I think that, again, I think the end state is going to be, an equilibrium is going to be found because, as with balance of payments and currencies, it's a relative value game. So where one flow is going, it's coming out of somewhere else, and vice versa. So again, on this relative value basis, the sequencing of it, to me, seems that the first sequence would be dollar lower. And then you're going to have, I think we have to look at that point, what are the initial conditions, in the global economy? If the United States is in like the worst position possible, basically it has slow growth, it's importing inflation, and there's nothing it can do to stop its currency devaluation except hike rates. That's going to be devastating. And, but that would be in a scenario whereby the rest of the world is actually still doing relatively well compared to the U.S. So I don't think that that type of delinkage would happen immediately. It's definitely an interesting thought for. I think that's maybe a few steps past what I had initially written about. But you definitely give us a lot of, especially give me a lot of food for thought about, how that final system, where the equilibrium would actually be.
Right.
Yeah,
What the end game might be down the line, because obviously the British pound was in decline for quite some time before it came to that point. And it was really a 30-year march from a massive amount of deficit spending that they did in World War II to the
right.
period where they had the IMF problem in 1976.
Absolutely. And yeah, past might be prologue for what's happening to the world's new reserve currency.
So, this has been pretty fascinating. I want to get from you your sort of final thoughts, just from a, near-term, actionable thinking, both developed market and emerging market, both currency and bond. How this, what are the considerations that you're making as a portfolio manager?
Right. So, as I said, I think that when this airs, I think we'll be through the election. So that's one big piece of uncertainty that we maybe have to come back and revisit. But what's not uncertain is the fact that we're seeing rising economic shutdowns, especially in Europe, and I'm worried that with the increase in COVID cases in the U.S. That we could see it in another engine of domestic growth. So given the given the fact that, and I know this might be kind of boring, but we've seen risk assets appreciate since March, but it's not only been on the back of policy, it's also been on now there's expectation that there's certain assumptions to the path of global growth which appear maybe are going to be optimistic even in these 2-year out scenarios. I think those will have to be revised down. So we're much more defensive near term because of these building risks versus valuations that we think maybe discounting a little too much at the time for the time being. So immediate actionable items. I think the interesting places again are the government bond curves where central banks haven't quite gone negative yet. So like looking at duration in Australia, New Zealand, I think even the UK is interesting, especially if they have a little bit. I think a messy Brexit would be best for the long end of the UKT because that way you would actually have the central bank implement negative policy rates, which might give you a little bit of juice, on that trade. I think on the currency side, we have to be very careful. I still think the yen, which, by the way, I'll take one just brief aside here. I like the allocation to the yen on the risk-off, property that it has, and it is one of the few, assets out there that you can start to think about in a vol shock, would provide some of that offset. That you're looking for in the 60-40 reallocation. I think the near term to most emerging market currencies is a bit lower, but if we can get through the election and get through a little bit of get through a risk hurdle and a growth hurdle in the near term, I think you're still going to have interesting plays in Mexico. You're going to have interesting plays elsewhere, where the higher, these kind of higher beta, still liquid emerging market countries can no longer be viewed in a basket. But the ones that we, are kind of interested right now in watching, we have not gone into them, but would be, Mexico and Russia, for a potential entry point after we get a little bit of spike in volatility.
And how much of the differential in COVID outcomes in the emerging markets has any relevance for you? Because, East Asia in particular, they've been outperforming relative to Latin America or Eastern Europe, for example.
Yeah, and we're favoring no, exactly. So we're actually in Latin America we're much more defensively positioned. We have in our we have in our local exposures. We do have full allocations across East Asia, Malaysia, Philippines. Even though in we're not quite going. We haven't gone into China yet. I know there's a lot of excitement about China and China being potentially a safe asset. I still get concerned that the authorities, although they appear to be liberalizing a little bit more, I want to see a true test case of that before I put any investor money to risk in China. But absolutely, Asia, it's not only the COVID outcomes, but it's actually their linkages to, the supply chains that are more technology linked. So, when we're looking at, the Asian, a lot of the Asian strength, not only have they been able to get COVID under control, they've also, been linked to, this recent demand for both technology and, healthcare equipment.
Excellent. Bill, we had to get that little extra juice out of you at the end. I really appreciate that. I mean, some great deep thinking in this. And please promise to come back so we can revisit with either your market ideas or some of the deep thoughts you have on digital currency and other places.
You're great. Thank you. I'd love to. And thank you for having me on again. It's always a fun conversation.